This is Investment 360. Joining us now from our studios in Cape Town, John Kinsley from Prudential. Thank you so much, John, for joining us today. Again, taking from the discussion a little earlier in the show, we're talking about the volatility and the immense uncertainty, and we know that Chris Hart is convinced that things could actually fall apart, a possible default occurring at this stage. How is this shaping your investment thinking at this point, and especially from a fixed income perspective?
Well, good evening, and thanks for inviting me. I think we just take a step back, and I am aware of Chris Hart's quite strong views. We're told that August was the most volatile month on global markets since the fall of Lehman Brothers, which may be the case. But if one has a look at the performance of various asset classes over the last 3 months, which is a short period, let's be honest, in an investment time horizon. But if one looks at that performance, South African equities fell about 4.5%. MECI World in dollar terms fell 7-8%. And so with South African cash doing 1.5% over those 3 months, the natural tendency for many investors, particularly those risk-averse investors, is to say, look, shouldn't I just put all my money in cash? And our advice to those investors has been no, that's not the right move to make, particularly if you've got an investment horizon of 3, 4, 5 years. If you have a horizon of sort of 12 months, well, then that's a different kettle of fish. But as soon as you're looking to invest over the longer term, it's interesting to note that despite all those falls that I mentioned and cash doing 1.5%, there were a number of South African asset classes that in fact over the last 3 months have done quite well. So South African bonds, South African inflation-linked bonds, South African listed property, all did over 5%. So it shows that in fact with some judicious asset allocation, without having to take too much risk, a client can still, through diversification, protect themselves to some extent.
John, Mohammed here. Just a quick question. I like your allocation to inflation-linked bonds. That's really protects your investor in terms of the real returns that he's receiving. But earlier today, I saw a report out of SocGen, and these kind of projections really based on your view on returns from asset classes over the next, let's call it 12 months to 3 years. Their view really saying that you're going to be looking at cash-like returns on equities, but carrying a lot more risk. Now, albeit that being on a global scale, what are your expectations for returns, let's call it over the next 12 months, from the various asset classes locally?
Well, look, I think, Mohammed, what we do is, when it comes to bonds, we look particularly at the real return. So in the case of an inflation-linked bond, you're looking at what is the yield currently being offered, because by definition, it is a real return, and be that sort of 2.5 to 2.8%. We would then compare that to the return offered on a conventional bond and say, well, which is offering us the better real return? And that is why in this particular portfolio, or the portfolio that I was asked to sort of look at being an enhanced income type portfolio, we're about 50% in cash, but 30% in corporate bonds because of the yield pickup we've been able to pick up there. And as you correctly point out, we have a fairly sizable portion in inflation-linked bonds because of the yield we've been able to derive. Having said that, we would argue that over the next 3 to 5 years, listed equity in this country is most probably on a forward yield at the moment of sort of 8.5% or so, is likely to give you a return, a total return, nominal, of 13 to 14%. But I can't say whether that return is going to be front-end loaded or back-end loaded. And for the typical income investor, that sort of uncertainty is not something they're comfortable with. So in a corporate bond or an inflation-linked bond, you tend to get a more pedestrian return. I'm not saying that you can't get negative months, but you tend to get a more pedestrian return, but at least you can tick up your income, as it were, for the overall return that the portfolio requires.
Well, as we've already said, that your cash portion literally making up 50% of the portfolio. Any thoughts in terms of allocating more money to inflation-linked bonds, given the fact that we are starting to see quite a strong performance coming through? And I suppose one also has to look at the monetary policy environment, possible interest rate cuts in South Africa, and a changing environment on an economic basis. How does that change your reweighting when it comes to asset allocation?
Yeah, look, I think we've actually been lower in cash. Earlier this year, we were sitting as low as 30. We've gone back up to sort of 45, 50, mainly because of the cash flows that have come into the fund. But having said that, we're a little bit wary of any forecast of interest rates. We find that you'll get it wrong as often as you get it right. So we prefer to look at real valuations and drive our investment process on that. I mean, I'm intrigued that 3 months ago, if you looked at the FRA curve and if you looked at the views of a number of economists, they were saying the next move in interest rates is up, and they were all saying, around about September. Those same economists are now saying, no, the next interest rate move is down. Now, I don't blame them for changing their views, but we would be very cautious of building a portfolio on forecasting. So we are looking at what the real yields are currently on offer and would rather build our portfolio accordingly. And certainly, up until fairly recently, we were getting some quite nice yields from South African bonds and particularly corporate bonds, and hence the allocation to that.
I think, John, I mean, another question I have at this point in time is, given the high uncertainty we're seeing in the market across asset classes, so you can take whatever it may be, bonds, equities, as you mentioned on bonds, we had completely divergent views if you compare just 6 months ago to now. Would a prudent approach for an investor out there looking for an income perhaps look at averaging into your type of fund, so perhaps a debit order rather than a lump sum investment? Would that be a strategy that you would be advocating to clients out there?
Mohammed, I must say that's where I differ from a lot of people. I'll stick my neck out and say that I don't believe in averaging into an asset allocation type fund, because then you yourself are making an asset allocation call above the asset manager. And I'm not sure that there are that many winners there. If you're investing in a pure asset class, a pure equity fund or a pure property fund, that would be different, because then I think you might want to phase in depending upon what valuations are saying. But if you're investing in a multi-asset class fund, the asset manager is taking a view already. And I think I don't believe it's wise to take a view over and above what the asset manager is doing.
John, you said something interesting a little earlier. You were talking perhaps, if I'm not mistaken, about new money coming to the fore, and you've just literally allocated it in cash. If I'm not mistaken, your cash position earlier was around 30%. Are you saying that we are still seeing new money flowing into the market, where we're still seeing appetite to allocate money within a fund?
Yes, I think that we have certainly seen fairly significant flows into our enhanced income fund, the particular portfolio I've been asked to address. And I think that's a function of particularly the fall in interest rates. I think we are seeing investors out there saying, with ordinary money market rates being 5.5%, can I not get a slightly better yield without having to take too much risk? Now, that's a balancing act. But I think we are beginning to see investors saying, I need to be prepared to take a little more risk and allow an asset manager to use corporate bonds, listed property, etc., in a judicious manner, so that I can get a slightly higher yield. Well, we don't believe that over time we're going to get an overall return much more than 2% above cash rates. But that can be quite significant for an investor who's looking for that slightly higher overall return without taking too much risk.
Exactly, because risk reward, of course. Since inception, let's just touch on that. Your fund has achieved a 10.5% return. The benchmark, which is, I think, the Olby, 9.1% return. So you've actually outperformed by 1.4%. But over the year, you've actually underperformed by 1.4%.
Correct. The Olby 1 to 3, as we call it, which is strictly not a fully investable type of universe, but it's one that we're happy to be measured against, had a particularly strong last couple of months. So because we're holding, 40% in bonds, you will find that we've underperformed that slightly. We're not worried about that over the 1 year, because essentially our investors are saying, beat the Olby 1 to 3, but more importantly, I'm going to measure you against cash, because I know what I can get on cash, and I'd like to see that if I'm going to take a little more risk, I want to be able to get a slightly better return than cash.
I'm quite interested.
And 2% above cash, if we can beat the Olby at the same time, we're very happy.
I'm quite fascinated by your international fixed interest portion there, 3.4% in the overall portfolio, and international cash at 1%. Please delve into what those holdings exactly are.
Look, what we're holding there is some corporate bonds offshore. They're certainly not sovereigns. Because those rates have come down even further. In fact, you would have made some money, because sovereign rates have come down even further with a crisis. But having said that, we don't find that appealing at all. So there were certain corporate bonds that looked fairly attractive to us, investment grade, and we've been able to allocate to that. And in fact, we have, since late last year, even here had a 2% weighting in offshore equity, which might surprise many people. But that has essentially been in some very high dividend yielding stocks, quality companies, where the dividend yield being offered on those stocks was higher than the 10-year bond yield in the same country. That's not an option that you get very often. So we were able to take a small position in that. We don't think it's appropriate in a fund like this to have a big equity weighting. It just blows out the tracking error too much in the volatility.
John, one more question. You mentioned corporate bonds, both locally and offshore. As the outlook globally, let's assume it's bearish, most commentators out there are fairly bearish at this point in time. And if the outlook for corporate profits, let's say 12 months down the line, starts to deteriorate, what would the impact of that actually mean for your fairly large allocation to corporate bonds in the fund?
Well, bottom line, it would certainly be negative. But having said that, we're fairly cautious of our duration here. So we hold a fairly short duration even with those corporate bonds if we can. And as a result of that, we limit some of the downside risk. You can, in many ways, hold on to the credit uptick or the credit spread and reduce the actual duration risk. And that's something that we do. It's a fairly technical issue, but that's something that we do a lot of. So what we try and do is say if there is a move in rates, let's try and sterilize or neutralize that as much as we can, but hold on to the actual spread that we're getting over and above government bonds. So that's the process we try and use in this fund.
Fantastic. John, we have to leave it there. Thank you so much for joining us and for your insights this evening. John Kinsley from Prudential.